The views expressed in this video are those of the panelists and do not necessarily reflect the views of U.S. Money Reserve.
Welcome to America's Gold Authority podcast. My name is Mike Barnes. The question for today is, how is your portfolio? Are you happy with it? Are you getting the returns you expect? Well, we have a couple of experts today who can help us along the way and give us some insight on something that you might be able to do. Philip Diehl is here, and so is Brad Chastain. And Brad, I want to start with you. As the Director of Education for U.S. Money Reserve, tell us, what is rebalancing a portfolio and why is it so important?
Yeah, rebalancing a portfolio is all about bringing a portfolio back to a status where it can work to meet your objectives. If you have a diversified portfolio, that means you have a variety of assets. You may have stocks, bonds, gold, real estate, a variety of different assets that behave differently at different times. Usually, or always, something is doing better than something else, but that doesn't continue forever. And over time, because of the performance, either something doing rather poorly or something doing well, you can get out of balance. And so typically what happens, especially with a traditional portfolio of just stocks and bonds, as somebody moves along closer to retirement, stocks tend to make more than bonds over time. They provide higher returns. The bonds are there to provide a level of stability to offset the stocks. But as we get closer to retirement, we should be becoming more conservative and protecting our money when we get closer to the time when we need it. But over time, as stocks tend to outperform the bond portion, people actually get overweight in stocks, taking on more risk than they had started with rather than less. And so rebalancing is just a disciplined approach to saying, I'm going to bring back the balance so that the portfolio is designed to do what it's expected to do, provide the right level of risk and reward.
Philip, as the 35th Director of the United States Mint and President of U.S. Money Reserve, I'm sure you've seen a lot of people who are out of balance and have lost money because they are too heavily weighted in one sector or another.
Absolutely. It happens all the time. And if you don't have a financial advisor who's really staying on top of it and getting you to focus on rebalancing once a quarter or so, then especially with stocks and bonds and gold prices, real estate prices changing so rapidly these days. It used to be that there wasn't as much volatility in these markets, and as a result, you didn't have to rebalance as much. But today, in today's markets, it's really crucial. And it's not just a matter of how your portfolio has performed in the past and how it gets out of balance that way, but also it needs to be rebalanced, as Brad indicated, as you age and as you get closer to retirement. You lower your risk as you approach retirement. You try to maintain returns, but lower that risk profile. And so that's one of the reasons why it's so crucial. And then the other thing that has to be weighed in rebalancing is, what is your view of the economy, of the state of the larger economy? What are stocks likely to do? What are bonds? What is gold likely to do? And if you become nervous, like a lot of us have become nervous about these extraordinarily inflated stock prices, then you need to factor that into your planning and rebalancing. There are more and more, I see more and more, and I'm not an economic, pessimist. I do think that inevitably there are corrections that occur in the market. That doesn't mean we necessarily go into a recession or a hard recession or financial crisis, but there are risks in the economy, and you see more and more voices, reputable voices, who are raising questions and doubts about this stock market. So I think that's another factor that people need to weigh as they rebalance their portfolios, how they see various asset classes likely to perform, and to adjust their portfolios based on that risk and where they are in their retirement timeline.
Yeah, and Mike, going back to your point about times in the past where this was so important. 2008 is the one that everybody remembers. I remember working with clients back in 2008 and 2009 who had gotten way overweight in stocks leading into that and not been rebalancing. And so as a result, when that happened, they lost way more than they should have if they had been maintaining the right level of risk and ideally reducing risk as they move closer to retirement. Many ended up having to delay, postpone retirement. Some folks even had to return to the workforce during that time because they saw their accounts that they were living on decline so drastically that as they were taking withdrawals, now the chances of them running out of money increased significantly. So balancing risk reward is always so critical with portfolios, and rebalancing is just a disciplined approach to do that. It also ultimately helps us do what we all say we want to do that hardly anybody actually does if they're not disciplined about rebalancing, and that's buy low, sell high. So often people let emotions drive investment decisions. How has this been doing? How has that been doing? This hasn't been doing well, I'm getting out of that. And then inevitably that turns around, whatever has been doing well, they missed all of those gains, they go in late, and then they lose a lot. They end up buying high and selling low, and that's clearly not the objective. And while nobody can really time the markets, that's been proven study after study, shows people generally underperform when they try to guess, but that disciplined rebalancing actually helps not only performance, because people avoid that, but also, most importantly, especially as we get close to retirement, maintain the right level of risk so that when things do change, they don't end up getting hurt too bad.
Yeah, I want to follow up. I want to follow up on Mike on that point. I think it's so crucial that we understand that there are these times in the cycle of the reassessment of our risk, of our stage in life, our assessment of the economy, what our goals are, that we do this reassessment. At the end of the year is a very typical time where people do that reassessment as they look forward to the coming year. And I'm going to do a little thought experiment here about two people. I'm going to be one of them. My next door neighbor is another, and we are deciding that we're going to rebalance our portfolios at the same time at the end of last year. And let's say I'm a pessimist. I think the economy is going to turn south. I think stocks, after a few months of rallying, are going to take a hit later in the year. I think for the year, stocks are going to be down. And so I think I'm looking for a way of protecting my portfolio, and I decided to buy gold. And I put a certain percentage, as I rebalance my portfolio, I put a certain percentage into gold in order to provide that ballast, that insurance, to protect myself against a falling stock market. My next door neighbor is more optimistic, and they keep their balance of stock in their portfolio. They don't buy gold, thinking that, I'm going to continue to ride this stock market rally, and I don't want to lose that increase over the next year, 2025. So I'm not going to shift into gold as insurance. Well, we come to today, and I get together with him and we look at the outcome, and been a pretty good year for stocks. You know, his portfolio gained 9.5% in his investment in the S&P over that period of time. So he did pretty good in the economy. It hasn't tanked. It has some question marks around it, but stocks have done great. So he's gotten a return of 9.5%. on that stock portion of his portfolio. Well, the portion of my portfolio that I put into gold earned 28%. And so even though the economy and stocks remained strong and set new records in the S&P, gold was setting new records too, and outperformed stocks by about 3-to-1. Now, this is not an unusual circumstance. Last year was a great year for stocks, increase of about 24%. Gold outperformed the stock market last year too at about 27%. And I look back, and 5 out of the last 10 years, gold has outperformed the S&P. So this notion that you're giving up by transferring a portion of your assets into gold as insurance, wealth insurance, that in doing that, you're giving up the potential gains you would get with your stock portfolio, hasn't proved to be the case. Wasn't that case last year? Hasn't been that case this year, even though they've been pretty good years for the stock market.
And longer than that. Gold has outperformed stocks over the last 25 years, quarter of century at this point. And so that's one of the really interesting things about gold as a diversifier within a portfolio. Traditional financial advice is stocks and bonds, and then you just shift that mixture over time. And by allocating to bonds, the idea is that you reduce the risk of stocks as you get closer to retirement, which is important, but there's also a significant amount of returns that are given up in exchange for that, which is okay when you reduce risk. You want to make sure you have an appropriate level of risk, and so you're willing to give up some returns in that case. But the interesting thing about gold is it's done as good of a job of diversifying the stock risk while also providing actually better returns than stocks over the last 25 years. So when you weigh stocks, gold versus bonds in how they work with stocks, a portfolio that uses gold instead of bonds, or at least as a large portion of what normally gets allocated to bonds, has done significantly better than a portfolio without gold from both a risk and a return perspective.
It kind of goes back to the buy low, sell high that you mentioned earlier, Brad, and it kind of makes me think about how often should I get a rebalancing of my portfolio, because Philip mentioned earlier maybe every quarter. He mentioned doing something at the end of the year. It seems like the more often that you do it, the more you're able to protect yourself. Is that correct, Brad?
Yeah, it's diminishing. So statistically, 1 year is enough for most people. An annual review, look at it, rebalance it at that point in time. Statistically, there are incremental benefits that you get from doing it twice a year or quarterly, but they trail off pretty quick compared. Like doing it once a year is way different than doing it every 2 or 3 years. But so if somebody wants to check up with it more frequently, yeah, there's some added benefit there, but at least once a year is where you get a bulk of the benefit. And that's for if somebody checks up with it more frequently as well. The other way that people will do is if there's a deviation from where they want to be of a certain magnitude. 5% is a common one. So if an asset gets to be 5% or more overweight, if somebody's watching it, they may rebalance it at that particular time as well.
Philip, I'm not sure how old your neighbor is, but does it matter how old we are? If we're in our 30s, it's one thing. If we're in our 50s or 60s, it's another.
Yeah, sure. It matters a lot. That's because if you're in your 30s and you've taken on a fairly high risk portfolio and you guessed wrong or you advised wrong and things don't go well, you have a long time to recover. And the stats show that typically you do recover over a long period of time. I think there's some question about now whether or not there's been a regime change and whether that will continue to be the case. But that has certainly been the case in the past, that you have a long time to recover and eventually you do recover those losses. If you're close to retirement, you don't have that time. You are counting on a certain amount of money to get you through the rest of your life and your spouse through the rest of her or his life. And if you take a big hit because you have maintained too high of a risk factor in your portfolio, then you may end up having to work longer or go back to work in order to make it all work out.
Yeah, and it's the time certainly plays a role, as Philip mentioned, but there's also a component to what somebody has saved versus what are they saving. And somebody who is just starting out also hasn't saved very much compared to what they're going to have in the future. A significant amount of the money that they're in their account is money they very recently put in, and what they are putting in is significant relative to their balance. And so it's a lot quicker to break even in that scenario, because you imagine if you don't have that much saved yet and you lose a significant percentage, it's still not that many dollars compared to what you're gonna have in 20, 30 years. And so what you're putting in makes up for that very quickly. So you got a lot of opportunity to buy low and it helps the returns, right? That happened to me 2008, for example. I had only been saving for a few years as I had started my career going into 2008, and I came out of 2008 much better than I otherwise would have if 2008 didn't happen, because I got that buying opportunity. But you get closer to retirement, your account balance is a lot larger. Losing a significant percentage, even if it's the same percentage, it's a lot more dollars, and what you're saving at those lower prices, if you're still saving at that point, is very low, so it doesn't have the same impact. So that's also the other side of that being younger equation. And once somebody's in retirement, they're not saving it all anyway, typically. So then it becomes extraordinarily crucial to make sure they're protecting against losses.
Here's another factor people need to be bearing in mind. There's a recent report came out that the Social Security Trust Fund will run out of money to pay full benefits in 2033. That's faster than what had been anticipated by a year or two. And so that's only 8 years away. Now, that doesn't mean that all Social Security checks are going to just be eliminated. But what it does mean is that there's going to be a significant chunk of everybody's Social Security check that will disappear. My recollection is it's like 18% or something. Brad, you may recall this better than I do.
Yeah, they estimate they'll be able to cover about 70, it fluctuates every year when they do the analysis, but it's between 77 and 78% of promised benefits they expect to be able to continue with no changes.
So 22% cut in Social Security benefits beginning in 2033 if Congress does not fix Social Security. I am not an optimist about how fast that will occur. It's absolutely clear it will not occur under the current Congress and president. As long as there's this divided government of deep partisanship, it's going to be really hard to get them to do something that big. The solution is going to have to be tax increases and spending cuts, maybe delays in retirement. It's going to require sacrifices all the way around. And, people in Washington don't like to make sacrifices these days.
I'll disagree. One thing, I think one of the big things is going to be not just tax cuts or tax hikes and cuts. It's going to be an increase in debt to continue to fund it as well. So I would expect that to be a big factor there as well. And we know how large the debt has gotten, even already crossing 37 trillion.
Yeah, so what it sounds like what you're talking about, Brad, is that there would be a subsidy, an additional subsidy out of the Treasury General Fund that would go into supporting Social Security. Is that what you're talking about?
That's very likely, I think, yes. That they would end up having to issue an additional debt, raise money for Treasury to be able to meet the obligated payments.
Yeah, and that brings up another point. We've talked a lot, and we hear a lot about the big beautiful bill and how it will increase the debt by $4.1 trillion plus another $700 billion for insurance costs. What that means is that's laid on top of the additional debt that is already baked into the budget. And what that means is that the current debt of $37 trillion in 10 years will be $47 trillion. Even if are no more cuts, the books are balanced for the rest of the 10 years, we're talking about baked in to this bill, $47 trillion in debt.
A lot of money. I want to point out one last thing before we go, is that we don't have to do this on our own as we're talking about rebalancing our portfolio. It's okay to get help, and especially if you don't know exactly what you're doing, you don't understand what gold has done over the last 25 years, and you have an expert that can help you. Brad Chastain, great example of someone who can help you figure things out, correct?
We're more than happy to, absolutely. And there's a very good chance that your financial advisor really doesn't even have an idea about gold and what gold has actually done within portfolios. Many advisors are only aware of the products that they offer and really only have stocks and bonds to offer as a solution. And so we've got great information to help you understand more about how gold has helped protect a portfolio in a greater way, in a more robust way than just stocks and bonds alone. So give us a call. We're more than happy to help you.
Very good. Philip Diehl, thank you so much for being here today.
Thank you. It's always a pleasure.
And Brad Chastain, we appreciate your insights as always.
Thanks for having me, Mike. Good to see you.
That is all the time we have for today's episode. On behalf of all of us here in the U.S. Money Reserve Studios, thank you for tuning in. If you have any questions or you want to learn more about today's episode, you can call the number in our episode description and speak with one of our friendly account executives. They're going to be more than happy to answer any questions you may have about precious metals and the strategic role they can play in achieving a secure and comfortable financial future. I'm Mike Barnes. We will see you next time on America's Gold Authority podcast.
The markets for coins are unregulated. Prices can rise or fall and carry some risks. The company is not affiliated with the U.S. government or the U.S. Mint. Past performance of the coin or the market cannot predict future performance. All calls recorded for quality assurance. Offer void where prohibited.